Hey, what's going on, traders? It has been a while, but I just thought it would be good for us to do a quick market recap, just to kind of identify what are some of the things that has been happening in the market, both from a macroeconomic perspective, but at the same time, also a technical perspective as well. And so the idea behind this little video is to merge those two forms of analysis to understand exactly where we're headed, particularly as it relates to next week. So over here, I have the dollar index, and what I want to do is I want to kind of break this down first and foremost from a macroeconomic perspective, and then kind of translate that information over onto the charts and see where we go from there. So with that being said, guys, let's just jump over to the FedWatch tool. I want to explain what this actually is. It looks quite busy, but it's quite simple. This is the tool that we would typically use to gauge the probability of what the Fed is going to do with interest rates. So is it going to keep it the same? Is it going to decrease it? Is it going to increase it? So essentially what we're looking at over here, we can see that for the month of April at least, we can see that rates are likely going to remain the same. There is no change that we can typically see down the line, and that has a lot to do with oil, which is something that we're going to touch on very, very soon. And then when we move over to July, you'll notice that the shift starts to kind of take shape, where as we move further into the year, what you'll notice is that the probability now decreases ever so slightly, where before it was certain that we're going to see rates remain the same between 350 and 375. But the closer we move to the end of the year, you'll notice that the probability of rate cuts happening down the line actually increases. So moving over now to July, notice that what we came from a 3% probability that rates are going to be cut now moves all the way up to 7%. So this might not seem big, but it does indicate that the further along the year we go, the more likely the Fed is going to make the decision to cut rates. And this has a lot to do with what's happening in terms of oil, what's happening with the Strait of Hormuz, and how this all kind of affects inflation. When we go over here and we look at the inflation for the US as it stands, you'll see that for the month of March, it is 3.3%, right? When we go to the forecasting section, what you'll notice is that at least moving forward into June, we're looking at a 3.5% um, increase, essentially just another 2.5%, sorry, a 0.2% increase from where we currently are. So what that tells us is that inflation is likely going to increase. And then when we move over to the bonds, we can see that the bonds remains elevated. And so what we take from all of this information is that the Fed is likely going to keep rates higher for longer on the basis that inflation remains a concern. Now, when we take all that information and we put it on a chart, and we start to see how US 10-year yields, bond yields is performing, and how that correlates with how oil itself is performing, we see that there's a healthy correlation between the two. And what that tells us about inflation, that inflation is likely going to continue moving up. And as inflation continues to move up, yields continues to move up as well to compensate for the weakening currency. And then at the same time, when we look at how gold is currently performing on this, gold actually moves invertently with what we see with oil and with yields. So we see that as the 10-year the 10-year yield bonds moves up, right? So as the yields of these bonds moves up, oil also tends to kind of follow, or as oil moves up, the bonds begins to follow. But then we also see over here on the green section that gold now moves in the opposite direction. And this is very important, guys, because now it explains why gold is performing the way it is. So I just want to go ahead and have a look and see what's happening with gold. And you guys will notice that in the bigger scheme of things, gold is still rather, rather elevated. However, although it's elevated, we must concede to the fact that it made a lower low, and now this is the third lower low. We have recently just broken a, sorry, a high, a lower high, and then a lower high over here, testing previously what was support. Then we've broken and made a new low over here. Uh, we did see that we had gold kind of build momentum to retest 48.50. And then since testing that, we see that there's been a bit of decline. Now, where do we go from here, and what does the information tell us how to position ourselves when it comes to gold? Now, essentially, when inflation is going up, this is typically an indication that the value of the currency is weakening. The purchasing power is being lost. Now, we take that same information and we put it against oil, and we see that within what we've been able to see happening with gold, oil is now moving up. Okay, why is oil moving up? Obviously, we understand the effects that the Strait of Hormuz has and how that ultimately affects the price of oil. So oil is now coming down, which was on the 17th of April, where it saw a low of $80 a barrel, $80.50 about there, $80.50 a barrel. Shortly thereafter, we see that due to ceasefire talks, and a lot of other geopolitical factors, the price of oil now increased, now trading back above 90. So oil remains quite expensive, which means inflation is likely going to follow suit, which means that yields is likely going to remain elevated, which means that the Fed is likely going to keep rates the same. What does all of this tell us about gold? It's very likely that we're going to see gold continue to decline. But when we look at gold from a holistic perspective, we saw that gold is now what was at one stage a very strong resistance area back at 43.40. That has now come to act as a support level, allowing gold to build momentum to the upside. And now we see that gold is slightly in a bit of a retrace. And so the question is, does this indicate that we're going to see a retesting of this low over here? Or do this help, or does this give us an opportunity to give that first higher low that would likely be the catalyst to either continue to just range like this over here, or does it have the capacity to even break above 48.50? These are things that we need to be paying very close attention to. At least in the short term, the way things are structured, unless the narrative begins to change and inflation no longer becomes a significant concern for the Fed, we're going to see gold decrease in value. Now, how far down can it go? That remains to be seen. Essentially, the safest thing to do will be to reference what was initially a price or a area of value or significance, which will likely be this area over here. So I would look at around 34.75 to be the area that if gold was to drop beyond this area, I would start looking at a possible continuation of downside momentum. But in the bigger scheme of things, we could easily see gold kind of ranging between these two prices. Price number one being 48.50. Price number two being 48.75. 43.75, apologies. So essentially what I'm going to be looking for is monitoring how does gold perform and how does gold move in between these two key levels. And if I find that there's a higher low that occurs, that's also going to be referenced, that's also going to be recorded, and that is also going to be taken into consideration when determining what we're likely going to see happen with gold. Now, the reason I draw in this downward sloping trend line is because upon a higher low that can occur, we might be under the impression, we might be under the assumption that this is going to be what pushes the market all the way up, testing new highs, breaking old ones. Essentially, we also have to consider the following, that if we have a higher low, we first need to break the barrier of 48, 42, and thereafter break this downward sloping trend line. Only then do we have the capacity to evaluate, position ourselves, and see the potential of gold kind of building further to the upside. But in order for that to happen, a significant narrative change will need to occur. So there has to be a lot of macroeconomic as well as geopolitical data that comes and supports gold as opposed to what we're currently seeing where the narrative actually supports the dollar. And so when we move over onto the dollar, we can see now that we've now recently just tested 100. Now, 100 was tested at least three or four times in the past, significantly, specifically, sorry, it was in July of 2025, November 25, and then we also had recently in March of 26, and then also towards the end of March 26. Not long thereafter testing, we saw a little bit of a dip, But again, notice what I see over here. I got that higher low that I was talking about. Okay, so that higher low that we suspect could occur on gold, that has already appeared on the dollar. So why is this so important? Why does this give us grounds to believe that the dollar has what it takes to potentially want to retest and possibly even break 100? Because the macroeconomic sentiment or the underlying narrative supports the dollar, in that we see that there's a continuous threat on inflation. Fed is likely to keep the rates high, and we can support this by looking at what's happening with the price of oil. And so, in my view, I could see that this little gap that we have over here is likely on its way to closing. So, therefore, this will be an area of significance that if the dollar was in fact going to run up, that will be the zone that I will see it running to. Over and above that, closing this gap, we could easily see the dollar testing 100, but that remains to be seen up until such time we see how the dollar responds to this little gap that we have over here. So as it stands, I see this as a valid higher low, but also a potential lower high, pending how we close above over here. And again, guys, if I have something like this that comes together, this is confirmation. This is confirmation. If I have something like this, that's confirmation as well. Okay, why do I say that? Because higher highs, higher lows are qualities and makings of a bullish trend. Lower highs, lower lows are qualities and makings of a bear trend. So that is the long and short of that. And then moving over now onto oil in and of itself. Now, oil with everything going on is a very strong indicator. Trading oil at the moment can be quite risky, even though the structure might be somewhat predictable, it might be somewhat clean in comparison. The level of volatility and the risk associated with it is a lot higher, mainly because of the fact that oil is now being driven by headlines, right? From a geopolitical perspective, anything that is announced or said in Washington has the capacity to affect oil. And so you run the risk of holding positions overnight when it comes to an instrument like this, where announcements are made over the weekend and upon market open on Monday morning, Sunday late evening, we see that the market tends to respond. So this is why I caution you when you're trading oil, especially for those of you that are a little bit more aggressive. I would caution you when it comes to this instrument and rather use it as an indicator. Use it as an instrument that gives you direction with what's happening with inflation, because inflation is going to tell you what the Fed is likely going to do with rates. Okay, so now moving over onto oil, where do we find ourselves? We now find ourselves back into trading above 90, right? So logically speaking, if we were to go over into the intradays, what we can see is that we've got this beautiful break back inside of this zone over here, breaking the prior highs. Currently using this as an opportunity and possible platform to retest, to push it all the way back to 100, pending what happens over the weekend and pending what happens with the announcement from Washington. So these are all things that we must consider, especially when it comes to the instruments that we're trading. And obviously, there are certain instruments that these affect, for example, euro dollar, which is inversely correlated with the dollar index. And so it's much easier now to trade instruments like euro dollar when we understand what's actually happening with the dollar. And so, guys, I really do hope that this little breakdown makes sense, that you could see how the narrative of our fundamental analysis kind of ties into the technicals, and how we can use that information to gain a deeper understanding, but at the same time identify the direction in which we are going, as the one gives us the explanation and the other gives us the opportunity. So, guys, from my side, I hope that you guys do well, have an awesome weekend. All the best with the market open on Monday, but for the most part, keep well and bye for now.